Do want to welcome in our next guest, though, for a more broad picture look at the market here. Joining us, Patrick Mueller, RFC and president at Bella Advisors. Patrick, thank you for being with us today. We got the Fed rate cut decision yesterday. Bit of a mixed picture when I'm looking at the big board right now, but we are seeing the market still hit at or near all-time highs. What's your outlook going into the end of the year? Are we going to have a Santa rally?
We sure hope we're going to have a Santa rally, and it's been nice here the last couple of weeks. We've had a run up after the downturn that we had in November, so it's been nice to see things pepping back up a little bit in the markets. Oracle's not helping anything, so get your act together, Oracle. And so I think that's the mixed feelings right now, is people are just really mixed up about tech right now and where that's heading into the future. And we've been trading sideways right now for a little bit, and so people need to be paying attention to that. So we're going to have a catalyst at some point here in the future where I think we will have a pullback. So I think if people are too heavily weighted into tech right now, then they should be getting a little cautious. Time to start taking some of those chips off of the table and repositioning it, and pounce on those opportunities when they arise throughout the course of the next year.
So we are seeing the NASDAQ and the S&P both lower today, but they're both also hitting new records while trading, as you mentioned, has been a little sideways, a little range bound, very choppy. What do you think's driving the disconnect right now between momentum and there's this hesitation, it feels like almost?
I think people are just uncertain at the long-term trajectory of what's going on in the markets right now. So you've got, NVIDIA, whose earnings came out, but then you got Oracle right now that didn't meet their earnings, and we're seeing that reflected in the markets right now. So people are feeling that things are way too overweighted in the tech sector right now, way too overvalued right now. And I don't know if we're completely at the peak right now when it comes to tech. I think we got more of a road to go with that. There's a lot of money that's going to tech, a lot of spending that's going on. But that's going to, once those tanks run dry, we're going to start seeing a pullback. So we just need to be prepared for that.
We're talking about this sort of overweighting of the tech stocks, and we've got the top 10 in the S&P making up about, I think, 37% of the index right now. This is even higher than the dot-com era, which a lot of people like to draw correlations to when we have this AI bubble conversation. How risky do you think this level of concentration is, Patrick?
I think it's super risky because it only takes one of these companies to not meet earnings where we're going to see just a massive pullback in the markets. And there's going to be some type of catalyst that we're going to see sometime, I think, in the near future, where it's going to create that catalyst for a market drawdown. And it'll be interesting to see what that's going to be. It could be the NVIDIA earnings, coming out in February, because they're just so massive right now, but there's so much concentration. And people don't want to miss out on that, because that's really the majority of the growth of the S&P right now. So it's hard not to want to be a part of that. I would just tell people to be very cautious. And we use something here called the rule of 100. And you take your age, and that's the percentage of your money that you should have safe and protected from market losses. And then the remaining percentage, it's okay to be taking risk with. So people, need to get closer to that, and just make sure they don't have too much money in the market. So when the tide goes out, right, we don't want to see who's standing naked out there.
And I mentioned the Fed off the top of our conversation. We did get our 25 basis point cut that was pretty much baked in yesterday. What was your thought on what we heard from Powell and also on the cut itself? Did it align with what you thought was going to happen?
Absolutely. Since late last year, Powell's been sticking to his guns as far as what they said that they were going to do. And they've been hitting all the rate cuts that they said they were going to be making this year. And they're looking at making one more into next year. So that'll be really interesting to see. But they're always late to the game, in my opinion. So we'll see what happens. And, that's going to be good for people who are trying to get into a new mortgage. Not so good for seniors and savers who are relying on, it's been nice to have decent money market rates and CDs and treasury rates. And so starting to see those things come down, not so good for those folks, but probably better for people who are wanting to refi their mortgages or people who are trying to get into a new home right now.
And I'm just looking at the 10-year right now. We're down more than 1%. We're getting 4.13, so getting closer to that 4% mark. You mentioned people who might want to refi or people trying to get into homes. How meaningful is this move back towards 4% for consumers and the markets heading into 2026? And also, do you think it'll hold?
I think it's probably going to hold. And when it comes to inflation and what we're going to see more of that coming from overseas. We're going to start seeing the the prices going up like we have been when it comes to a lot of the tariffed goods and that are coming into the country. But long term, it's going to be really good with all the tariff moves because now we can sell into a lot of countries that we weren't able to sell into before. So it's going to be really good for producers here in the country. So when it comes to those long-term interest rate moves, it's going to be good to keep that down, especially when it comes to debts. Credit card debts are at all-time highs. So people are starting to refinance out of their 2% and 3% mortgages, and they've been refinancing into 7, 8, 9+% mortgages to take the money out to basically refinance their own debt. So it's a little scary what's happening right now. So I think, bringing those interest rates down is going to be good from that aspect.
And Patrick, I saw in a recent note that you're telling your investors and clients to take some profits and rotate into value. Who do you like right now in this current setup?
I always like Burke B. It's hard to bet against the Oracle of Omaha, not Oracle, the company right now, right? But the Oracle of Omaha, Warren Buffett. So, just having value stocks and stuff that we know we can close our eyes on 5 years from now. We know that those industries and companies will have done well. So I like that stuff. JP Morgan is good right now. It's the better ones in the banks. And so those are things that I like right now when it comes to those things. And with the markets right now, what people need to understand is you hear these phrases that personally drive me nuts when markets are down, that it's only a paper loss. But nobody ever tells you, Marley, that it's only a paper gain. It is not a gain until you realize it either. So never be afraid to take a gain. And so it's always good to take some of those chips off the table. We can always redeploy that money at some point in the future. I just I hate seeing people get caught off guard.
Patrick, we appreciate you being with us this morning, as usual. Patrick Mueller, RFC and president at Bella Advisors.